We're going to do some intrinsic value calculations on three companies that are reporting earnings soon. So today's Thursday, January 29th, and after the closing bell, Visa is going to report their earnings. So we're going to take a look at them. And then Friday before open, SoFi and American Express are also reporting their earnings. The Interflame Finance valuation method and scoring method doesn't really handle financial companies, but what we're going to do is we're still going to look at intrinsic value calculations for these three companies. In the description of this video, you'll find links where I show you how to build out these four different valuation models. We have the PE ratios model, we have the dividend discount model, we have the discounted cash flow model, and we have the Peter Lynch valuation model. Now, in this video, we're only going to look at the PE ratios model and the discounted cash flow model, mainly because Peter Lynch is especially bearish on a lot of the companies that we look at, and we will make modifications in future videos and future analyses based on that. And also the dividend discount model, while some of these companies do offer dividends, they're not the biggest dividends. They grow their dividends, especially Visa. We see that their dividend growth is quite high. However, for Visa, it's not a very large dividend. And so we're just going to look at, for comparison's sake, the PE ratios model and the discounted cash flow model. So if you want to make these spreadsheets yourself in Google Sheets, and you want to use your own numbers, you want to look at other companies, the link in the description will show you how to do that. There's four different links for four different valuation models. We're going to start with Visa. Visa, we are assuming that for the next 5 years, they're going to grow 14%. Dividend growth, we're assuming that that's going to be 7%, although that's not really going to matter in these models since we're not doing a dividend discount model. Current free cash flow, they are raking in quite a bit of cash flow. So that's $21.5 billion of free cash flow. They have about $19 billion of cash and cash equivalents. Their total debt is $26 billion. And there's 1.9 billion shares outstanding. And so when we take a look at all those numbers and put them together in these models, we see that the intrinsic value of Visa, according to our calculations, is $386. And their current price, as of recording this video, is $327. Now, how does that compare with the analysts? Well, the analysts are pretty much in line with what we said. We said that it's about $386. The average analyst expectation for Visa is almost $400, $398. The high estimate's coming in at $450, and the low estimate is pretty much flat at $330. The consensus is a strong buy for Visa going into earnings, and we see that that is based on 7 different analysts saying strong buy, 15 are saying buy, and 1 is saying hold. So a 15% margin of safety is pretty nice. Typically in Interflame Finance portfolios, we look for a 20% margin of safety or higher. However, if Visa were something that we wanted to buy or something that we wanted to add to, it's just something we absolutely had to have, then we would certainly consider Visa at these valuations. Next up, we have American Express. American Express is expected to grow 10% every year for the next 5 years. Current free cash flow is about $19 billion. Cash and cash equivalents, about $53.5 billion. Total debt, $60 billion, and shares outstanding, 689 million shares. And so the PE ratios model comes in at 362. Discounted cash flow model coming in very high at 627. We're going to average those two together and find an intrinsic value of 494. Current stock price is 357, so that gives us a 27.8% margin of safety. So the average estimate is actually coming down for American Express. American Express is currently trading for 357, and the average analyst has American Express over the next year coming in at 335. That's between a 4 and 5% drop. So not as bullish as we are by far. As a matter of fact, the high estimate coming at 425. And we're saying that it's 494 based on these calculations. If we were to throw in the dividend discount model, that would bring us down closer to 388 and more in line with what expectations are on Wall Street. It's still on the higher end, but this is something that, based on our numbers, American Express has a lot of growth. However, analysts don't feel nearly as strong about it. Strong buys are 5 for American Express, buys are 3, holds are 11, no sells, and there are actually 2 strong sells for American Express. So a lot of mixed data, a lot of divergence in the numbers. Let us know in the comments what you think. Now, if you're getting anything out of this video, please consider liking the video. Consider subscribing to the channel to come back for more finance, investing related content just like this. So SoFi, we are looking at just the PE ratios model because their current free cash flow is negative. So the discounted cash flow model is not really going to help us. We look at growth of 21% every year for the next 5 years, which is pretty bullish and pretty high up there, but hopefully they can execute. They are a growth company and they are executing on that growth. Cash and cash equivalents about $3.2 billion, total debt $2.8 billion, and 1.2 billion shares outstanding. According to the PE ratios model, that gives us a price of $25. The current price is also $25. The reason why the margin of safety is not 0% is we are rounding to the nearest dollar, and these prices are off by a few cents. And so basically what we're seeing is that SoFi is fairly priced currently at $25 per share. And the average consensus on Wall Street is basically the same thing. Average is $25.75 for SoFi. We can see that to the nearest cent, their current stock price is $24.60. And so that does not give us a lot of room for growth for SoFi, somewhere between 4 and 13% growth based on the average and the median. The high expectation coming in, $37 per share. That would be a 50% increase, and the low estimate coming in down 31%. Now, SoFi is a stock that we bought at Interflame Finance when it was $6, $7, $8 a share. We bought quite a bit of SoFi, and we are happy with our position right now. So given the valuations, given their current intrinsic values and where their current stock price is, and the fact that their free cash flow is still negative, this is something that for Interflame Finance, we are going to hold off on. Anything that we say in this video is not financial advice. We are not telling you to buy, hold, or sell any security in your portfolio. Please always do your own research and your own due diligence. One way of doing your own research is by going to the description of this video, checking out the links, and building out your own 4 intrinsic value calculators so that you can run your own models with your own numbers and compare to what we have. So in the comments of this video, let us know, what are you buying? What are you looking forward to in this earnings season? What are you holding? What are you selling? Do you agree or disagree with any of our picks? We'd love to hear from you. We love having that conversation. We appreciate you watching very much, and we'll see you in the next video.